Stop getting stopped out. Market liquidity secrets exposed. Do you ever enter a trade and watch price turn the moment you click buy? That sting is common, and it convinces many traders that markets are chaos. They are not. What you are feeling is the pressure of liquidity and incentive, the places where orders gather and stronger hands do business. Once you see that map, the noise quiets and your decisions slow down. Today on Mind Over Markets, you will learn a plain mental model for reading intent, not prediction. We will outline how to spot quiet accumulation, how to recognize absorption when effort fails to move price, and how to avoid crowded comfort zones that invite stop runs. You will leave with simple rules for risk, clear chart cues to follow, and a checklist you can practice on any instrument. If you have been overtrading, chasing green candles, or moving stops out of fear, stay with me. Let us put awareness ahead of anxiety and protect capital first. Here is why this lesson matters right now. Volatility arrives in pulses, liquidity thins at the edges, and most traders respond by clicking faster instead of thinking clearer. Mind Over Markets exists to reverse that reflex. We combine behavioral insights with market structure and risk design so you can read intent and act with discipline. You will not hear predictions here. You will learn a repeatable way to locate where informed participants prefer to do business, how to frame risk so one loss never derails your day, and how to wait for your window. The aim is simple. Replace anxiety with awareness, replace guesses with checklists, and replace chasing with planned execution. If that sounds different from typical trading content, good. We are building a practice, not a personality cult. The focus is process, probabilities, and protecting capital above all. Most traders learn the hard way that markets can feel personal. You buy a breakout and price snaps back. You short a breakdown and it pops in your face. You move a stop once, then twice, and the third time the market tags you to the tick and runs. The account curve turns into a saw blade. None of this means you are cursed. It means you are stepping into crowded behavior. Popular levels pack orders. When the crowd piles in, larger participants have a simple job. Fill inventory where liquidity is thick, then push price to where it is thin. That is why false breaks cluster around obvious lines, and why the reversal always feels like it targeted you. Layer on human bias and the pattern tightens. Fear of missing out fuels late entries. Loss aversion keeps bad trades open and cuts good ones early. Recency bias convinces you that the last candle predicts the next. Overconfidence appears right after a win and asks for size you did not plan. Fatigue and boredom nudges you to click just to feel engaged. The result is overtrading, inconsistent risk, and random outcomes. The antidote is not prediction. It is seeing the game others are playing, then choosing when not to play. In this lesson, we will name the behaviors, examine the footprints they leave, and replace vague advice with rules you can execute. The goal is to shift you from reaction to intention, and to make risk management the backbone, not the afterthought. From there, consistency follows, and confidence rebuilds slowly. Here's the core idea that will guide everything you do. Markets are not a slot machine. They are a system where price moves to find liquidity and to balance competing incentives. Your edge is not prediction. Your edge is a repeatable way to locate where informed participants are likely to act, define risk in advance, and accept uncertainty as part of the cost. You read intent by watching structure, volume, and the result of effort. If strong effort fails to move price, someone is absorbing. If price glides through a thin area, it is traveling where resistance is low. You wait for alignment, plan the exit before the entry, and size so a single loss is small. That is the philosophy. Process over impulse, patience over noise, protection of capital above any single opinion. Start with accumulation by informed participants. In quiet phases, strong hands build inventory without advertising it. You often see a balanced range that does not resolve despite bursts of aggressive orders. That is a hint that passive liquidity is meeting those orders. The why is simple. Large players need to enter without moving the market against themselves. The how is to watch for stable value areas with repeated failed pushes away from the range, and for volume building at the middle rather than at the extremes. A practical chart cue is a tight range with wick rejections on both sides while cumulative volume grows, and the point where most trading occurs does not shift much. A simple risk rule here is to trade small against the edges only when the range shows evidence of absorption, and to cut the trade if the value area clearly migrates. Now look at absorption versus aggression. Aggression is the side that crosses the spread with market orders. Absorption is the quiet side that keeps price from advancing despite heavy effort. Why it matters is that mismatches between effort and result reveal intent that is not obvious to the crowd. The way to spot it is to look for sequences where large buying fails to lift price, or large selling fails to push it lower, and where the response is a sharp move in the opposite direction once the aggressive side tires. A chart cue is a cluster of tall candles with long bodies that net to very little progress. A risk rule here is to wait for the failure of effort to break and then enter with a defined stop beyond the failed zone, and to size small because reversals from absorption can be fast but noisy. Next is liquidity engineering. False breaks and stop runs are not always random. They are often a way to create the liquidity needed for larger orders to fill. This matters because traders who enter at the obvious level become the liquidity for others. You can spot this by noting where obvious highs and lows sit, and then watching for a brief push beyond them that stalls and reverses. A simple chart cue is a quick spike through a well-watched level followed by a close back inside the prior range. The risk rule is to avoid chasing the first break and to prefer entries once price closes back within structure with a stop beyond the spike. Consider distribution mechanics. After markup, informed participants reduce inventory into strength. You will see rising price but waning momentum, more failure to continue, and an increase in churn near highs. This matters because optimism peaks near tops, and that is when inventory transfers from patient hands to impatient hands. Spot it through volume shifts from trend volume to rotational volume and through frequent failed pushes at the top of the range. A chart cue is a series of higher highs with smaller advances and heavier volume on down candles. A risk rule is to take profits into strength rather than predict the exact top, and to avoid adding size late in a run. Build your risk architecture early. The heart of survivability is position sizing, structure-based stops, and a max daily loss that you respect. Why it matters is that even excellent reads fail often. Your edge needs room to breathe without one trade or one day causing major damage. The way to apply it is to decide on a percent of capital per idea, place stops where your read is invalidated by structure, and keep a journal that tracks not only win rate but average gain and average loss. A chart cue here is simple. Place the stop beyond the level that would prove your read wrong rather than at a round number. The risk rule is to keep single trade risk small and to stop the session if you hit your max loss. Learn volume profile and structural context. High volume nodes are places where a lot of trading occurred and they can act like magnets for rotation. Low volume nodes are corridors with little resistance where price can travel quickly if reclaimed. This matters because it helps you anticipate rotation versus glide. You can spot it by plotting the distribution of traded volume across price and by noting where value areas overlap and where they shift. A chart cue is a return toward a high volume area after a failed breakout. A risk rule is to fade moves back into value with small risk and to avoid fading a move that is gliding through a low volume corridor without sign of pause. Examine crowd comfort zones. Popular support and resistance levels feel safe but often gather stops. That visibility can turn into vulnerability. This matters because the more eyes on a line, the more orders cluster there, which can feed a stop run. You can spot it by scanning for levels that everyone has drawn and by measuring how often price has tapped them. A chart queue is a level with multiple touches and clean bounces, followed by a decisive pierce and reversal. A risk rule is to avoid placing stops exactly at the obvious line, and to consider using a buffer beyond where stop clusters likely sit. Develop order flow literacy at a basic level. You do not need to become a tape wizard to benefit. What matters is understanding how price arrived at a level, not only that it arrived. If strong buying was needed to push into a level and then price stalls, it suggests absorption. If price drifts into a level on weak effort and then accelerates, it suggests a pocket of thin liquidity. A chart queue is a divergence between the energy of the move and the distance it travels. A risk rule is to align your trade with the side that shows lower effort for the same result, and to bail quickly if the tape shifts against you. Think of market phases as behavior rather than as a rigid cycle. Accumulation is patient buying in balance. Markup is expansion when that balance breaks. Distribution is patient selling into enthusiasm. Markdown is the mirror of markup. This matters because each phase favors a different playbook. You can spot phases by the shape of ranges, the location of value, and the quality of breakouts. A chart queue is a failed attempt to leave balance that quickly returns and rotates, which signals the phase has not changed yet. A risk rule is to trade smaller during transitions and to increase size only when a new phase is confirmed by structure. Practice timing and selectivity. Doing less often accomplishes more. Your job is to wait for clean windows where structure, profile, and flow are not in conflict. This matters because most losses come from trading in noise. The way to apply it is to define what an A setup looks like for you, including location, context, confirmation, and risk-reward, and to sit out when the picture is messy. A chart queue is a clear retest of a broken level with rejection in the direction of your bias. A risk rule is to allow a small number of well-defined attempts per day and to stop clicking when conditions do not match your plan. Learn to recognize confluence moments. Alignment is when technical structure, volume patterns, order flow, and the current phase all point the same way. This is not common, and that is why you must be patient. It matters because alignment shifts probabilities in your favor. You can spot it by checking that location is favorable, that volume profile supports the move, that recent flow agrees, and that you are not trading against the phase. A chart queue is a breakout from balance that immediately accepts above the level, pulls back to retest light volume, and then lifts with little opposition. A risk rule is to size slightly larger on true alignment and to trail stops behind structure rather than chase price. Add a module on context-driven stop placement as an expansion of risk design. Stops belong where the thesis is invalid, not at arbitrary percentages. This matters because structure removes guesswork and reduces the urge to widen stops in fear. You can spot the invalidation point by asking what level would prove the other side has control and then placing the stop beyond it with a small buffer. A chart queue is a rejection wick at your level, followed by a higher low or lower high that lets you snug the stop behind a structural pivot. A risk rule is to never move a stop farther once placed, and to only tighten it if structure justifies the change. Include a module on journaling and feedback loops. An edge is not a feeling, it is a set of behaviors that can be measured. This matters because improvement compels evidence. Apply it by tracking setup type, context, entry reason, stop reason, risk taken, result, and a short note on whether you followed the plan. A chart queue is less relevant here, but you can snapshot before and after images to review context. A risk rule is to reduce size after a sequence of plan violations and to earn size back through consistent execution rather than through wins alone. Round out with a note on environmental awareness. Not every day is designed for your playbook. Event risk can change the texture of order flow. Holiday sessions can thin out liquidity. This matters because your performance distribution will be dominated by a few good days and preserved by sitting out bad environments. You can spot conditions by checking a calendar, scanning pre-market structure, and assessing whether ranges are expanding or compressing. A chart queue is a narrow overnight range that sits inside prior value, which often signals choppy open. A risk rule is to start small, scale only if conditions behave as expected, and to walk away if behavior deviates. When you put these lessons together, you get a way to read intent without predicting. You look for quiet accumulation, for absorption that blocks effort, for engineered liquidity around obvious levels, and for distribution that sells enthusiasm. You frame everything within a risk architecture that makes one loss tolerable. You use volume profile to judge magnets and corridors, respect that crowd comfort can turn into traps, and lean on basic order flow tells to judge effort and result. You identify the phase, wait for a clean window, demand confluence, and put the stop where the idea is wrong. You measure what you do so your future self can learn. Above all, you defend capital so that time can compound your edge. Now, practice with 3 quick exercises you can complete today. Open a past session where you felt lost and mark the areas where price balanced rather than trending. Circle the center of activity and note how often pushes away were rejected. This builds your eye for quiet accumulation. Next, replay a breakout and watch the effort it required versus the distance it covered. If heavy buying or selling produced little travel, tag that sequence as absorption and write one sentence that explains why. Then, find an obvious level with many touches, list where most traders likely place stops, and sketch a safer alternative location. This rewires the habit of parking risk at the crowd line. Set a 24-hour practice challenge that fits your schedule. In N.1 or N.2, one instrument and one session, decide on a single A setup in advance and allow yourself at most 2 planned attempts with fixed size. If conditions conflict with your checklist, do nothing and record why you stood down. After the session, write a short debrief that includes context, entry reason, invalidation level, risk taken, and whether you followed the plan. Take 2 screenshots if you can, one before and one after, and describe how the footprint of participants changed. And by committing one improvement rule you will apply tomorrow and one behavior you will stop doing regardless of outcome. Repeat until the habits stick. Case 1 is an index future on a morning open after an overnight balance. Pre-market shows value overlapping the prior day, and the cash open pushes above the balance high by a few ticks and stalls. Effort rises, but progress does not. Footprint or even simple candle bodies show buyers pressing, yet price fails to accept above the level. That is your clue that liquidity is being harvested. The risk plan is to wait for a close back inside the balance, sell the first clean retest of the failed breakout level, place the stop a small buffer above the spike high, and risk a fixed fraction of capital. The outcome is a rotation back toward the center of value where you take partial profits and a runner that either tags the opposite edge or trails behind lower highs. The lesson is to avoid chasing the first break and let the market tell you what it accepts. Case 2 is a crypto pair during a weekend where liquidity is thinner. A popular horizontal support has 3 clean touches on the 4-hour chart, and social feeds are full of the same line. Price grinds down on light energy, pokes a few points below, triggers stops, and then snaps back above the level within the same candle. The clue is effort-result mismatch in the break and fast reclaim that signals trapped sellers. The risk plan is to buy the reclaim with a stop below the flush low, keep size modest due to weekend conditions, and target the nearest high volume zone from the profile as the first objective. The outcome is a quick push to that magnet and a partial exit, with the rest managed by a structure-based trail. The lesson is that visibility creates vulnerability, and reclaim entries put you on the right side of that dynamic. Across both examples, the common thread is acceptance versus rejection, effort versus result, and a risk plan that defines invalidation first so that one decision does not end your day too early. Fear of missing out feels like speed, but it's just panic wearing a mask. Give it a job. Before any entry, run a pre-commitment checklist aloud. Location fits the plan. Risk is defined. Size is within limits. Context supports direction, and the exit is written. If any item fails, you sit out for one full bar and reassess. Revenge trading thrives on heat. Cool it with a reset ritual that cannot be skipped. Stand up, step away for 2 minutes, sip water, and log one sentence about what the market just proved, not what you wish. Only then may you open the platform again. Loss aversion whispers that avoiding a realized loss keeps you safe. It does the opposite. Counter it with a rule that celebrates clean execution. Tag each trade, pass or fail, on 3 metrics: respected stop, followed plan, stayed within risk. A green score on process earns permission to continue. A red score on any item means reduce size to half until 2 green trades restore normal. Add 1 more guardrail for days that drift. If you click twice without context, the session is over. Your best trades happen when patience holds the pen, not adrenaline. Here is your quick mental checklist before any trade. Confirm location first by asking whether price is at a meaningful area from recent structure, not in the middle of noise. Read effort and result to see if aggression is being absorbed or accepted. Check volume profile for a return toward a high-volume node for rotation or a low-volume corridor for fast travel. Avoid crowded comfort lines that collect stops and look for reclaim or rejection instead of chasing breaks. Define risk where the idea is wrong and place the stop beyond that level with a small buffer. Size within a fixed band so a single loss is small, and commit to a hard daily loss limit. Demand a clear window with alignment across structure, profile, flow, and phase, and skip when signals conflict. Plan the exit before entry with partials at magnets and a trail behind structure. Log the trade, score your process, and adjust size only after consistent execution. Protect capital first, then let time compound skill. Your turn. Tell me where you struggle most right now: location, risk, or patience. Type the word awareness in your comment so I can find you and answer. If you want feedback, drop a before and after screenshot link with 2 sentences on your read and your risk. I will pick a few for a community chart review. Download the checklist from the description and tape it next to your screen for the next session. Subscribe if this helped you slow down and think clearer, and share it with a trader who needs calmer decisions. Next up, we'll unpack acceptance versus rejection in depth and build a simple playbook you can rehearse. This content is for education and pattern recognition only. It is not financial advice and does not recommend any security, instrument, or strategy. Markets involve risk, including the possible loss of capital. Trade only what you can afford to lose, follow your written plan, journal each decision, and seek professional advice where appropriate.